Hi, David here, the CEO and founder of the Freedom Founders Mastermind community. You know, there's a behavioral axiom in the investing world that goes back ages and ages and ages. It's been prevalent since probably the beginning of time when people first started to figure out, how to invest in something, whatever that might have been, centuries ago. What is that axiom? It's FOMO. It's fear of missing out. And we see it over and over again during every market cycle. The market always cycles. We have business cycles and market cycles that tend to run in tandem or fairly close. The National Bureau of Economics and Research has been following these cycles for well over the last decade, back to the 1800s. And typically every 7 to 9 years, we have a business cycle. Now, sometimes they're shorter in between, and sometimes they're longer, like this last period. Since the great financial recession of 2008, 9, 10, 11, started coming out of it in 2012, we're now 10 years, well into a decade of an upper run bull market, if you will. We've seen the bull market in financial assets. We've seen it in real estate. Just about everything that had any kind of investment grade to it has done relatively well until it doesn't. And that's when we go into a correction where the cycle tops out and we go down the other side, again, into a correction or typically some kind of recession, different levels based on how much things have gone up. Usually that dictates a little bit on the other side how much things go down. With respect to that, I would expect that as we go into a recession, and we may be there right now, I'm not going to make an absolute prediction, but I believe that we are rolling into a correction. I believe the correction could be relatively deep because we've had such an upbring. So back to the axiom of FOMO, or fear of missing out. What I see so often, and I see it right now, is the Johnny-come-latelys, late to the party. Everybody's doing it. Everybody's having fun. I've been sitting on the sidelines. I've been busy doing other stuff. And just now I'm awakened to the fact that, there's this thing called crypto. Gosh, I should get into crypto, or the financial markets are doing great. And I should get into the latest, whatever that might be, wherever the thrill of the market is, or real estate. People are making money hand over fist. We've seen the year over year appreciation factor in single-family housing on a national basis has been well over 20%. People feeling like, gosh, I've been missing out. Fear of missing out. Now, if you have been on the sidelines, you haven't jumped in, let me just give you a little caveat. And it's hard to go against the grain here because behavioral psychology is so strong in this regard. You need to move to higher ground. Meaning, if you don't understand what you're doing, if this is new to you, if you're entering a new market, financial, real estate, cryptocurrency, I don't care what it is, whatever you think is hot or been hot, don't plan on staying there. The game is moving. The cheese has moved already, and you're getting in late to whatever it is. Whatever the track record has been, whatever the returns have been over the last several years, or even the last 4 or 5 or 6 years, they're going to change. The models change. People look at real estate all the time, and they see it through one lens. Well, I should go out and buy properties. I could start with single family, or maybe I'll get into a multifamily, or if I don't want to be active, I'll get in some hot syndication, because there's syndications everywhere. My gosh, you can get in syndications where they're promising internal rate of returns of well in excess of 20%. And it's like, boy, I'm going to get into that next one. It's cooling off now. It's cooling off rapidly. I'm not saying that there's not opportunities. There's always opportunities, but how do you know? How do you find those opportunities when you haven't been in the game? See, real estate and tangible assets like real estate and business are far different than financial markets. Financial markets, in my opinion, is no place for a retail individual investor to play ball. I mean, yes, if you want to buy mutual funds or ETFs or index funds, if that's what you like, you're buying the market and you get some level of safety. But overall, I would say the financial markets are headed for a very, very nominal, very boring, very mediocre return rate over the next decade. I think that run-up has been had. Now, you could say the same thing. What about real estate? I mean, doesn't real estate follow cycles? To some extent. But with real estate, it's an inefficient marketplace, in a place where if you're plugged in, if you have access, if you understand due diligence and underwriting, if you put a little time and effort into it, and it does take time and effort, you can navigate the niches and the voids in the market to still stay on that higher ground. We do that all the time in real estate. Having lunch with a good friend of mine who wants to get more involved in real estate investing, and he's meeting with some friends and some people who have been flipping land, close to the interstate, where the home builders will come in and buy this land and to put their subdivisions in. Well, yeah, the last 2 years there's been a frenzy of new home building, a frenzy of it. Well, because people needed homes and the inventory was low, and cost of money was cheap and people wanted to get out and get bigger space because of COVID. All made sense, right? Well, we've topped that out. We're coming down right now. Interest rates are going up. Demand is going down. Home builders, if you look at their stock prices right now, they've been falling. There's so many new starts on the marketplace right now. And I told this friend, I said, hey, you're coming late to the party. You're getting in late. He said, well, what should I do? I said, you need to seek higher ground. Well, what does that mean? Well, again, I could spend more time on that. There are great places in real estate to seek that higher ground where you can still be earning good yields, but be in a safe place and not at the top of the market in the equity arena, which is what he was planning on doing. You have no business being there if you haven't been in the game and you don't know what you're doing. That's a very dangerous time, but there are places to be where you can be in that higher ground. That's what we do. Those of us who are plugged in and we have the access points in a very inefficient marketplace, it's a place where you can preserve your net worth and actually increase your net worth. We make actually more money, more net worth when the market is going down, correcting, than we do in up markets. You make money in both, but how do you do it in down markets? That's the art of the deal. That's what we do. Anyway, I want you to stay focused on your freedom. Don't go for the FOMO. Be so careful right now. It's hard to do, but I'm just telling you, do it and you'll thank me. You'll thank me in a year. You'll thank me in 2 years if you stayed on higher ground. Talk to you soon. Remember, always stay focused on your freedom. See you next time.